Hi, I'm Jenny Brown. Welcome to this week's MFB News. I hope you're keeping very, very well indeed. You may have noticed we're now recording this video on Fridays rather than Wednesdays. Everything else is going to be the same kind of format and content. It's just simply the day of the week that has changed. So what have we got for you this week? Well, first of all, we're going to be covering off how the war in Ukraine is impacting mortgages in the UK and also share some thoughts on what's going to happen with that going forwards. I'm then going to talk to you about a couple of new products that have been released, which are very, very interesting indeed. We're then going to just talk a bit more about the interest rate changes we've seen in the last week. And then I'm going to share with you some data that's been released by the Mortgage Works with regards to tenant demand and also rental income for Q4 2021 as well. Okay, so first of all, how is the war in Ukraine impacting mortgages in the UK? So I think the first thing really to address is that the cost of oil and gas is going up, and that is going to therefore push up inflation to even further than people predicted it would be. So the latest numbers that people have been mooting, saying inflation could reach 9% or even go further than that, just depending on what happens. So the fallout of that is obviously inflation is increasing, and there's a very, very strong chance that bank base rate will go up. Last time the data was released, there was a 105% likelihood of base rate going up next week, with a further increase in May. There's no Bank of England meeting or MPC meeting in April. So first of all, obviously interest rates, those people who borrow linked to base rate, but also what's happening is in the money markets, swap rates, which are the rates at which banks lend each other money, essentially have also increased. And this tends to knock on to fixed rate borrowing for new mortgage rates being released into the market. So what this means is that the cost of funds has increased to lenders. They're passing that cost on to borrowers, which means that mortgage rates, as you go to obtain a new mortgage going forwards, are increasing. So the very first knock-on effect of the war in Ukraine is really that it's going to push up the cost of borrowing against mortgages. Now, the other thing that's just worth noting is because of the impact on inflation, when lenders are looking at particularly homeowner mortgages, residential mortgages, what they do is they look at affordability. So what they do is they will take your net monthly income, they will knock off various costs that you have. So one of those would be your standard living cost, and that's according to ONS data, plus any other commitments, loans, credit cards, that kind of thing. And whatever is left at the bottom is the amount of money they feel that you have left over to pay towards your mortgage. So with the ONS data showing that household costs have increased, that means that the number that they're knocking off your income for this particular set of expenditure has increased, and therefore you're left with less money per month, which means that the amount you can borrow or are deemed to be able to afford to borrow comes down. So there are some lenders in the residential space who have amended their affordability calculations and are now lending people less money. So that's definitely another impact of what could fall out with the war. Now, in terms of actual lending policy more broadly, lenders' appetite to lend, concern about the housing market, all that kind of stuff, we're not hearing any chatter from the lenders in that regard at the moment. Lenders are holding very firm. There's no talk about lenders curbing criteria beyond the numbers that I mentioned previously. So at the moment, it's not having any impact in terms of lenders' appetite to lend. And I think it's really worth mentioning more broadly actually what landlords are feeling. Obviously, we're talking to landlords every single day. And I think it's fair to say that some landlords are being incredibly robust. They're carrying on as normal. They're out actively looking to acquire properties, and it's business as usual for these guys. There are also some investors who are saying, well, actually, at the moment, I'm a little bit uncertain about the future. I'm nervous about inflation, so actually for now I'm just going to hold off making an investment. So there are some landlords who are understandably just biding their time and waiting for things to shake out a little bit further before they make any large financial decisions. But I would say that actually is very much the minority of people that we're speaking to. The majority of our clients are actually very much actively still looking to continue with their business kind of objectives for the year, as per they were, pre the war starting. But what we are definitely seeing is landlords who are expediting plans to remortgage. People are very conscious of the fact that interest rates are going to be going up throughout 2022. They're looking to lock in rates, fixed rates, and actually longer term fixed rates as well. So I've never seen so many people asking about 5 and 7 year fixed rates as I have done over the last few weeks. So people are very conscious about the fact we're in for possibly quite a bumpy ride in this regards. So looking to really secure rates and lock things down to give them some real stability going forwards. So if that is something you would like to give us a call about, we'd love to hear from you and give you some costings. In last week, the Yorkshire Building Society have enhanced their HMO proposition. So previously what they were doing is only lending on HMOs to limited company entities. They've now broadened that to incorporate lending to individuals as well. What they also had, it was some geographical restrictions in terms of where the HMOs could be. And actually they were sort of, I guess, fairly understandable. So what they were saying is they were only really looking to lend on HMOs in certain large city locations where obviously the demand for such a type of property is very, very strong. They've now removed those restrictions, so they're lending on HMOs throughout the country. So in terms of their proposition, how that looks, YBS can lend on properties with up to 12 letting rooms. You must have a HMO mortgage with these guys, 4 buy-to-lets already. And like I say, they can lend to individuals now and also limited companies. Where I think the Yorkshire Building Society come into their own is particularly in the limited company space, because they are traditionally a commercial lender. So they're able to really understand those more complex company structures, maybe where you've got children as shareholders, layered companies, that kind of thing. But yeah, like I say, it's really great actually. They've really reconsidered their offering in that regard and, you know, opened the doors up to individual borrowers as well as limited companies. Now, Aldermore have released a limited edition product, which I think is actually very, very good. So the product is a 5-year fixed rate. It's available for individuals and limited companies at 75% loan to value for loans up to £1 million. And pricing here, so 5-year fixed rates now from 2.68%. So in a market where 5-year fixed rates are inching upwards, 2.68%, particularly in the limited company space, and there are some other bits of the criteria which I'll come into in a second, but that's actually very, very competitive. So we're really pleased to see this product come to market. Now, limited edition means that there's only a certain amount of money that's available on that particular interest rate, and once a lender has received the applications to the tune of that amount of money, they simply pull the product. So it's not around forever. And as a brokerage, we don't know how long it's going to be available for. So if this is something that you're interested in, please get in touch as soon as possible. Now, the other thing I would say is that Aldermore are not the fastest lender at the moment. So if you're watching this, you're really up for a 5-year fixed rate mortgage, but you need the money really, really quickly. This probably wouldn't be the one for you. But if you've got time on your hands, then this one would be very interesting. So available for purchases and remortgages, limited companies and also individuals. Now, here's some bits about their lending proposition, which I think is quite niche. They can lend to trading companies as well as SPVs, and they're also able to consider layered companies, so a company, owned by people. They don't mind how many properties are sitting in the background. They can lend in Scotland. They are able to consider consumer buy-to-lets and let-to-buy. So a consumer buy-to-let is a buy-to-let on a property which was not acquired with the sole purpose of renting it out. So for example, you inherited it, you have been living in it, but now you're going to rent it out, that kind of thing. So they're able to do that. They have no minimum income requirement, and they're happy to accept applications as long as the deal will end by the eldest applicant's 85th birthday. So essentially you can be up to age 79 at the point of application. Now, the other very good thing is on remortgages, they are able to offer free legals and free valuations as well. So a very, very competitive product coming out, which is a great way to kind of tee up some of the other rate changes which I'm about to go through with you. Okay, so in the last week we have seen Santander withdraw products and increase rates on the remaining products that they've got left over. The increase on pricing there is by up to 20 basis points. We've also seen Barclays increase all of their fixed rates by 0.35%. We've seen TSB withdraw all of their 10-year fixed rates, and we've seen Fleet Mortgages increase their products by 0.1%. The Skipton have also released some rates. They pulled a bunch of products previously. They've now re-released them. They're just slightly higher than they were before. And TSB again have also increased the remaining rates. They withdraw their 10-year fixed rates. The remainder have been increased by up to 0.3%. We've seen the Clydesdale increase their 2-year fixed rates by 10 basis points to 0.1%. And we've also seen the Leeds Building Society withdraw some of their products as well and not replace them at the moment. I feel the reason we're seeing withdrawals of products and then a delayed re-release is just the lenders are really struggling to kind of pitch their pricing, secure funds on a certain rate before bringing them back to market. So they're pulling rates because they know that they can't sustain lending at that particular price. But what they haven't done at that point is secure the new pricing to re-release. That's why we're seeing a kind of stagger between withdrawal and replacement. Now, TML have also removed all of their limited edition products. What they have done though is increase their minimum loan amount as well. So it used to be £25,000. They've now increased that to £50,000. So a busy week again from the lenders this week. Now, the Mortgage Works have released 2 reports in the last week, which are the results of surveys of landlords, essentially. Now, I always really enjoy reading these because it really just tells us what's going on with the landlord community. It always makes really interesting reading. So 2 reports, one is tenant demand, the other one is rental income analysis, and both of these are covering off the research they did in Q4 2021. So under tenant demand, they asked landlords the following question: in your opinion, what has happened to tenant demand in the last 3 months? 27% reported that it had increased significantly, 29% reported it increased slightly. So 56% of respondents, so over half, have reported an increase in tenant demand of some description. 21% reported no change, 3 saw a slight decrease, 1% saw a significant decrease, and the remaining 19% simply weren't sure at all. So I think that's a really positive news story for landlords in that tenant demand continues to grow. We saw it increase in Q3 21. In fact, it's been increasing since Q2 2020. Obviously, that was when we were right in the sort of start of the pandemic. And looking at the data, things have really just improved since then, with a big step up in Q3 2021, and then a further step up in Q4 2021 as well. And I think we can largely look at these numbers and see the kind of change in tenant demand really kind of mirroring what's been going on with the various lockdowns and the COVID situation. Now, looking at this more regionally, the strongest tenant demand is certainly being seen in the southwest. They reported the highest level of tenant demand, and this is followed by Wales and Yorkshire and the Humber. The region which is reporting the sort of lowest level of tenant demand, or worst change as it were, was the northeast. I have to say I find that quite surprising because we're actually hearing a lot of landlords who are very keen to invest in the northeast at the moment. So whether maybe that area has been oversaturated, I don't know. But actually, you know, if you are thinking about investing, just know that the landlords who are based in the southwest, Wales and Yorkshire and the Humber, are the guys who are saying that the tenants are really, tenant demand is really strong. Okay, and then just moving on to the rental income analysis report. So the data that I've extrapolated from here that I found really interesting was that the second half of 21 saw the average gross rental income generated by landlords steadily increasing with an uplift of £2,000 in Q4. So the average gross rental income for these landlords surveyed was £59,000 per year. Now, what they go on to say is that the annual rental income generated per property has also risen to £8,550, and that's an increase of £408 from Q3 in 2021, which is a 5% increase from that quarter. Now, interestingly, the proportion of landlords reporting that they have received an increase in rents in the last 12 months continues to rise significantly, and those intending to increase rents in the next 6 months is also up. So in numbers, 42% of landlords have increased rents in the last 12 months, and a further 39% plan to increase rents in the next 6 months. So in terms of where the market is, you know, I think there's a really good story here for landlords in terms of rental income demand is still holding incredibly firm and increasing, and actually rents are also increasing too. And that is everything for me this week. Thank you so much for joining us. Look, I'm going to wish you a good weekend as we're on Friday now, so I hope you have a great time. I think the weather's going to be rather nice on Saturdays, so do try and get out and enjoy that sunshine, because we all know how pressured it is at the moment. If you do have any questions, we would love to hear from you. 0345 345 6788, or have a look at our website. I will see you again next week. Until then, do look after yourselves.